I'll never forget the feeling in my gut during my first big market crash. I'd finally saved up what felt like a fortune, put it all into the market, and for a few weeks, I felt like a genius. And then, the floor dropped out. Every headline was screaming sell. Every chart was a waterfall of red. And every single instinct in my body, every primal fiber, told me to get out. To run. To save what was left before it all vanished. My brain was just hardwired for panic. But what if that gut-wrenching dread is actually a biological flare, signaling that you're on the verge of a generational buying opportunity? What if, while your brain is screaming threat, the market is whispering discount? This isn't about ignoring fear. It's about understanding it, decoding it, and using it. Your brain wasn't designed for modern financial markets. It's ancient hardware running outdated survival software. It sees a 30% drop in your portfolio and thinks it's a saber-toothed tiger leaping from the bushes. The response is identical. The amygdala, your brain's fear center, hijacks your rational mind. It floods your system with the stress hormone cortisol, wrecking your ability to make complex decisions. Your heart rate spikes, your vision narrows, and you are primed for one thing: survival. In that state, the only command your brain can really process is make the pain stop. And what's the fastest way to stop the pain of watching your life savings evaporate? Selling. You hit the button and, for a second, you feel relief. The anxiety fades. But what you've really done is turn a temporary, on-paper dip into a permanent, real-world loss. This biological trigger is then amplified by a powerful social instinct, herd mentality. We evolved to find safety in numbers. On the savannah, if the herd started running, you ran with them. No questions asked. The one who stopped to ask why got eaten. In the financial markets, this exact instinct creates crashes and destroys wealth. Selling triggers more selling in a contagious feedback loop. Everyone's running for the exit, so your brain screams that you should too. This is the herd, and they're stampeding right off a cliff. The financial world has a name for this moment. It's called capitulation. It's when the last optimist gives up, hope dies, and everyone is convinced the downward spiral will never end. This is the point of maximum financial opportunity. This is where wealth is transferred from the impatient and panicked to the prepared and disciplined. In this video, I'm going to show you how to biologically override that fear. We're going to install some new software. Using ancient Stoic techniques combined with a modern understanding of markets, we'll build a system that lets you not just survive a crash, but actually profit from it. I call this framework Stoic Arbitrage. It's about acting with cold, calculated precision while everyone else is losing their minds. It's about learning to see the world as it is, not as it feels. It's about turning the market's greatest weakness, its tendency for mass panic, into your greatest strength. So, how do we do it? How do we systematically take apart this ancient fear response and turn it to our advantage? It all comes down to a framework built on 3 core pillars. This is how you stop being a victim of your biology and start becoming the master of your financial destiny. Section 1, the mental framework. Decoupling from the herd. The first and most important battle isn't fought in the market, it's fought in the 6 inches between your ears. Before you can even think about buying a dip, you have to rewire your response to it. This isn't about chanting affirmations or just being brave. It's about building a tough, systematic mental framework. The Stoics called this an inner citadel, a fortress that outside events can't breach. For us, it means building a psychological defense against the irrationality of the herd. This is our first pillar, decoupling your decision-making from the market's emotional chaos. We'll do this with 3 specific techniques. Pillar 1, pre-commit to written rules. The single best way to bypass your own flawed biology is to make your biggest decisions when you aren't under stress. A fighter pilot doesn't figure out how to handle an engine failure while the plane is spinning toward the ground. They follow a checklist written and memorized in the calm of a briefing room. As an investor, your market crash checklist is your written investment plan. And I don't mean a vague mission statement. This has to be a concrete, rules-based document that dictates your actions during extreme volatility. You create this plan when the markets are calm, your cortisol levels are low, and your prefrontal cortex, the rational, planning part of your brain, is in the driver's seat. This document is your commander in the heat of battle. You don't think, you don't feel, you don't second guess. You just execute the plan. What does this look like? It has to be specific. It should clearly define your long-term goals, your risk tolerance, and most importantly, your exact rules for buying and selling. For example, your plan might say, I will not sell any of my core holdings unless the fundamental reason for owning the company has been permanently broken. A market-wide drop of 20%, 30%, or even 50% does not count. Then, you define your buying rules. For instance, if the S&P 500 drops 20% into a bear market, I will deploy 10% of my cash reserves. If it drops 30%, I'll deploy another 15%. If it drops 40%, I'll deploy another 20%. These are just examples, your numbers will depend on your own situation. The key is that the rules are decided ahead of time. By creating this written plan, you're building a defense against your own worst instincts. It defeats recency bias, the belief that what just happened will keep happening forever. During a crash, this bias convinces you the market will never stop falling. Your written plan, based on a long-term view, is the direct antidote. It also short-circuits availability bias, where vivid, emotional memories hijack your thinking. The ghost of the 2008 or 2020 crash can feel so real, making you believe this time is the end of the world. Your plan, written in a state of calm, forces you to act on logic, not on the ghosts of past traumas. During a crash, you need to review this document daily. Read it out loud. It's your anchor in a storm. This practice reinforces discipline and actively fights the cortisol-fueled impulse to panic sell. This written plan is the first and most critical piece of software for overriding your biological panic button. It's your personal protocol for financial sanity. Pillar 2, Cognitive Reframing. From Sea of Red to Generational Discount Event. The next layer of our mental framework is the ongoing practice of cognitive reframing. It's the art of changing your perspective to change your emotional response. The facts of a market crash are neutral. Asset prices went down. The story you tell yourself about those facts is what creates either panic or opportunity. The herd story is about loss and disaster. The Stoic story is about discount and opportunity. You have to consciously train your mind to see a screen full of red numbers not as a loss, but as a sale. Think about it, if your favorite store announced a 40% off, store-wide sale, you wouldn't panic. You'd grab your shopping list and rush over, excited to buy things you want at a huge discount. A market crash is the same thing. It's a limited time everything must go sale on high-quality financial assets. This isn't just wishful thinking, it's a perspective backed by over a century of market data. Your best tool for this reframe is to zoom out. When you feel the panic rising, pull up a 30, 50, or 100-year chart of the S&P 500. What you'll see is a clear, upward sloping line, dotted with terrifying drops that, from a distance, barely look like blips. You'll see the '87 crash, the dot-com bust, the 2008 crisis, and the 2020 pandemic. And you'll see that every single one was followed by a powerful recovery to new all-time highs. Let's anchor this with hard numbers. Historical data shows that since World War II, the average bull market lasts over 4 years, with average returns of nearly 150%. In contrast, the average bear market is over in less than a year, with average losses of around 30%. You are trading temporary pain for a much larger, longer-term gain. If you had bought stocks when they were down 30% or more, your average total return 5 years later would have been a staggering 88%. What's more, the market's best days tend to happen right next to its worst days. If you panic sell, you don't just lock in your losses, you dramatically increase the chances of missing the powerful rebound that follows. Missing just the 10 best days of the market over a 20-year period can cut your total returns in half. The people who really get hurt in crashes aren't the ones who hold on, they're the ones who sell, miss the recovery, and then buy back in much higher, terrified of missing out. By repeatedly looking at this long-term data and consciously relabeling crash as sale, you start to sever the emotional link between a falling market and a sense of personal threat. You are literally retraining your amygdala. You're teaching your ancient brain that the saber-toothed tiger is just a really good discount on your financial future. Pillar 3, Weaponize apathy through exposure limits and AMP. Negative visualization. The final pillar of our mental fortress is all about controlling your inputs. That panic response in your brain is fueled by a constant stream of negative, sensationalist information. Financial news networks and social media aren't in the business of making you a better investor, they're in the business of selling ads. And nothing glues eyeballs to screens like fear. The dramatic music, the flashing red banners, the markets in turmoil specials, it's all designed to trigger your amygdala and keep you watching. You have to ruthlessly cut off this fuel supply. This is how you weaponize apathy. During a market crash, your information diet is just as important as your investment strategy. Limit yourself to checking financial news once a day, maybe for 15 minutes in the evening. Get your data from neutral sources, raw numbers, not breathless commentary. Turn off all notifications from your brokerage and news apps. The goal is to create a calm, quiet space where your written plan can be executed without the deafening roar of the herd. You can't decouple from the herd if you're mainlining their hysteria 24/7. The second part of this is a proactive Stoic technique called premeditatio malorum, or the premeditation of evils. In simple terms, you imagine the worst-case scenario ahead of time to insulate yourself from its emotional shock. For us, this means stress testing your portfolio. While the market is calm, use a spreadsheet to simulate what a nasty crash would do to your holdings. Ask yourself, what would my portfolio look like if it dropped 30%? 50%? Even 60%? Look at that number. Feel the discomfort. Now, imagine yourself going about your day with that lower portfolio value. You still have your job, your family, your health. The world hasn't ended. You're still breathing. Then, picture yourself calmly following your written plan, deploying cash to buy assets at those bargain prices. What this does is turn a terrifying unknown into a familiar scenario. When the real crash happens, your brain doesn't see a new, unprecedented threat. Instead, it recognizes the pattern from the simulation you already ran. It thinks, oh, I've seen this before. I know this script. I have a plan. This mental rehearsal builds incredible resilience and strips the crash of its power to shock you into a panic. By combining a low-information diet with negative visualization, you build that inner citadel. The chaos of the market can rage outside, but it can't touch you. You've cultivated a state of strategic indifference. While everyone else is glued to their screens on a cortisol-fueled emotional roller coaster, you are calm, detached, and ready to act. You've systematically overridden your panic response. Their hysteria is now your arbitrage. If this framework for building an unbreakable financial mindset is making sense to you, and you want more strategies on combining ancient wisdom with modern wealth creation, do me a favor and hit that subscribe button and turn on notifications. We're building a community of rational, long-term investors, and every new subscriber helps us cut through the noise. Your support is what lets me create in-depth guides like this one. Section 2, Tactical Patience and AMP, the setup, the mechanics of the value gap. Okay, so we've forged our minds into a fortress. Now we can move from the psychological why to the tactical what and when. This is where the arbitrage actually happens. This section is all about the mechanics of execution. It's not enough to be calm, you have to be calm and effective. This requires a strategy I call tactical patience. Tactical patience is the exact opposite of the simple, and often disastrous, advice to just buy the dip. Buying the dip without a plan is like trying to catch a falling knife. You're probably going to get hurt. Tactical patience is an active, watchful waiting. It means holding a significant amount of cash, our dry powder, and refusing to use it until the market gives us a very specific set of signals. We are not trying to guess the bottom. We're waiting for the market to confirm that we've reached a state of peak irrationality. This state of peak irrationality creates what I call a value gap. This is a moment where asset prices completely detach from their real value because of mass, fear-driven selling. It's in this gap that we find asymmetric opportunities, scenarios where the potential upside is many times greater than the potential downside. So, what are the specific, measurable signs of peak irrationality that tell us a value gap is open? We'll focus on 4 key criteria. This is your tactical checklist. Criterion 1, extreme VIX spikes. The VIX, or the SIBO Volatility Index, is often called the market's fear gauge. It measures the market's expectation of future volatility. A low VIX means complacency. A high VIX means fear. An extremely high VIX means raw, unfiltered panic. Historically, a VIX reading above 40 is considered high. A move above 50 signals extreme panic and is a strong sign of investor capitulation. For context, at the peak of the 2008 crisis, the VIX shot above 80. During the March 2020 COVID crash, it hit a record close of 82.69. These moments represent the absolute peak of fear. Execution discipline, your plan is to wait for these spikes. Don't start buying just because the market is down 10% and the VIX is at 25. That's often just the beginning. Be patient. Wait for the VIX to cross a threshold you've already defined in your plan, say, a VIX of 45 or higher. When this signal flashes, it's your first green light. It tells you the market is pricing in Armageddon. At this point, you can start to deploy a preset amount of your dry powder, maybe 20 to 30%, but only into assets whose long-term value you've already confirmed. Criterion 2. Evidence of mass liquidations and capitulation. A VIX spike tells you people are scared. Mass liquidation data tells you they're acting on that fear in a big way. This is the blood in the streets that contrarian investors always talk about. We need to see hard proof that investors are being forced to sell. There are a few things we can watch. First, look for exceptionally high trading volume on down days. This shows the selling isn't shy, it's forceful and widespread. Second, watch indicators of market breadth, like the percentage of stocks trading above their 50-day moving average. When this number drops below 10%, it means the selling is indiscriminate, people are dumping everything, good and bad. That's a classic sign of capitulation. Another powerful, more advanced indicator is the put/call ratio. This ratio measures the volume of bearish option bets, puts, versus bullish bets, calls. A reading above 1.0 means bears are in control. A reading that spikes above 1.5 suggests extreme pessimism and is often a reliable contrarian buy signal. Execution discipline. Your plan should combine these signals. For example, I will only start deploying capital when the VIX is above 45 and the percentage of stocks above their 50-day moving average is below 15%. This combination gives you a much higher probability entry than using any single indicator alone. When these conditions are met, you can also look for assets that are extremely oversold, like with a relative strength index, RSI, below 20, to help pinpoint your entry. Criterion 3, the quantified value gap. This is where we put a number on the discount. How cheap is cheap enough? Feelings are useless here. We need objective measures. One great method is to compare an asset's current price to its long-term average valuation. Using something like a discounted cash flow, DCF, model or even a simple historical PE ratio, you can estimate a fair value for a company or the market. A value gap opens when the current price drops to a deep discount to that fair value, for example, trading at less than half of its 3-year average. This isn't about being perfectly precise, all valuation models are flawed. The goal is to have a rational, quantitative anchor to stop you from overpaying or from being too scared to buy. It's a sanity check that confirms the panic we see in the VIX is actually creating a tangible, mathematical bargain. Execution discipline. The key here is position sizing and scaling in. No matter how good it looks, you never go all in at once. The market can always go lower than you think. Your plan must dictate how you enter a position. A smart approach is to scale in over time. Maybe you buy your first third of a position when your signals are met, another third if the price drops another 10%, and the final third if it drops 10% again. This dollar cost averaging on the way down lowers your average cost and reduces the risk of bad timing. You also need to define your Uncle Point A stop loss to protect you if you're just plain wrong. Criterion 4, the discipline of dry powder. None of these tactics matter if you don't have the ammo to act. The foundation of Stoic Arbitrage is having cash on the sidelines, waiting. This is probably the hardest discipline of all, especially at the end of a long bull market when FOMO is raging and cash feels like a useless, dead asset. Your investment plan must specify your target cash allocation. For a true opportunist, holding 20 to 50% of your portfolio in dry powder during market highs isn't a sign of fear, it's a sign of strategic foresight. This is your war chest. Execution discipline. The discipline here is twofold. First, you have to be tough enough to hold this cash and watch the market go up without you. This requires supreme patience. Second, you must have the discipline to not deploy this cash until your predefined criteria are met. The temptation to start buying too early is huge. You have to resist. Your cash is your power. You deploy it on your terms, not the market's. You wait for your pitch. This blueprint is what transforms you from a gambler into a hunter. You're just waiting patiently for the herd to stumble, creating the perfect opportunity for you to strike. Section 3, Real-World Execution. Historical proof of Stoic arbitrage theory is great, but doubt can still creep in. Does this actually work? Can I really do this when it matters? The most powerful antidote to this final fear is proof. Let's look at history, not for a guarantee of the future, but for a clear, repeating pattern of human behavior. The strategy of Stoic arbitrage, systematically profiting from the panic of others, isn't new. It has worked in every major market crisis of the modern era. Let's look at 3 quick case studies. Case study 1, the COVID-19 crash. March 2020. The start of the pandemic in 2020 triggered one of the fastest market drops in history. The S&P 500 plunged 34% in just over a month. The narrative was terrifying. Global commerce just stopped. The headlines were apocalyptic. Let's check our signals. The VIX exploded, shattering its 2008 records to close at 82.69 on March 16. That was the signal of absolute, off-the-charts panic. We saw mass liquidations as investors dumped everything. It was a textbook panic. And here, investors went down two very different paths. The herd, driven by primal fear, sold in droves near the bottom in late March, locking in devastating losses. They ran for the perceived safety of cash, making their temporary losses permanent. The Stoic Arbitrager did the opposite. They saw the VIX at 85 and recognized it as a screaming buy signal. They saw world-class companies trading at 40 to 50% discounts. They consulted their written plan, ignored the noise, and started buying. They deployed their dry powder right into the heart of the panic. The result? Those who panicked missed one of the most violent rebounds in market history. The market bottomed on March 23 and recovered all its losses by August. The panic sellers were left behind, waiting for an all-clear signal that never came, and were eventually forced to buy back in at much higher prices. The disciplined investors didn't just recover, they compounded their wealth at an incredible rate. Wealth was transferred, directly and efficiently, from the hysterical to the prepared. Case Study 2, the Great Financial Crisis, 2008. If the COVID crash was a heart attack, the 2008 crisis was a long, slow cancer. The S&P 500 fell a staggering 57% from its peak. This crash looms large in our collective memory, fueling the fear of the next one. The signals were obvious. The VIX exploded in the fall of 2008 after Lehman Brothers collapsed, peaking at over 80. That was the moment of total capitulation. Headlines declared the end of the financial system. The fear was real. And the herd, understandably, ran for the exits, convinced everything was going to zero. What did the Stoics do? They followed the lead of their modern-day avatar, Warren Buffett, who famously wrote an op-ed in October 2008 titled "Buy American. I Am." His motto was simple: be fearful when others are greedy, and be greedy only when others are fearful. This wasn't a feeling, it was a calculated arbitrage on human emotion. While others were dumping financial stocks for pennies, Buffett was making deals, injecting billions into companies like Goldman Sachs on incredibly favorable terms. Disciplined investors followed suit. They bought shares in major banks trading for less than the cash on their balance sheets. They bought blue-chip companies at valuations not seen in a generation. The result was a mirror image of 2020. Emotional investors who sold near the 2009 bottom locked in life-altering losses of 50% or more, and many never trusted the market enough to get back in. The disciplined contrarians who bought the value gap saw their investments generate massive returns over the next decade. The pattern is identical: peak fear provides peak opportunity. Case Study 3, the dot-com bust, 2000 to 2002. This crisis was different. It was a mania of greed that collapsed into a 2-year winter of despair. The tech-heavy Nasdaq fell by a soul-crushing 78%. The same herd mentality that had created absurd valuations on the way up, bankrupted those same speculators on the way down. Many believed it was a new paradigm on the way up, and many believed tech was dead on the way down. Both were wrong. The Stoic Arbitrager in this environment didn't just buy the dip. They applied a layer of analysis. They understood that while the hype was dead, the internet was not. So, while the herd was dumping any stock with .com in its name, the disciplined investor was sifting through the rubble for the few companies with real business models and real revenues. They were buying shares in a little online bookstore called Amazon for as little as $6 a share. They were scooping up stock in a software giant named Microsoft. They looked past the short-term carnage to the long-term, technology-driven future. The outcome follows the same relentless logic. The hype chasers were wiped out. The patient, value-oriented investors who bought the survivors at fire sale prices laid the foundation for fortunes. The wealth transfer was, once again, absolute. The lesson from these three different crises is the same. The triggers change, the headlines change, but human psychology doesn't. Markets are simply a mechanism for transferring wealth from the active to the patient. History is clear. The question isn't whether the strategy works. The only question is whether you'll have the discipline to execute it. Alright, we've covered a lot of ground, from our primal brain to the practical tactics of buying a crash. Let's boil it all down. That panicked feeling you get when the market tanks isn't a signal to sell, it's a biological glitch, an evolutionary echo that's actively bad for your financial health. Stoic arbitrage is the system you build to override that flawed instinct. First, we build our inner citadel. We do this with 3 pillars. 1. We pre-commit to written rules, making our biggest decisions when we're calm, not chaotic. 2. We actively reframe a sea of red as a generational discount event, using history to train our minds to see opportunity, not a threat. 3. We weaponize apathy by cutting out the noise and practicing negative visualization, so a crash becomes a familiar scenario, not a shock. Second, with our psychology locked in, we practice tactical patience. We don't just buy the dip. We wait for specific, measurable signs of peak panic, like a VIX spike above 40, mass liquidations, and a clear value gap, before we deploy our dry powder. Finally, we draw confidence from history. We've seen that this pattern is not a fluke. From the dot-com bust to 2008 to the COVID crash, the story repeats with incredible consistency. Wealth flows from the panic to the prepared. This is not easy. It takes foresight to hold cash in a bull market. It takes courage to buy when every instinct screams at you to run. But it's not a superpower. It's a skill. It's a system. And it's a process you can learn. By building this system, you're doing more than just planning to buy low. You're achieving a kind of financial sovereignty. You stop being a victim of market cycles and your own emotions. You become an active agent, capable of turning widespread fear into personal prosperity. You learn to be calm when others are frantic, rational when others are reckless, and greedy only when others are terrified. That is the essence of Stoic Arbitrage. If this guide to Stoic Arbitrage resonated with you, and you want to keep exploring how to build a more resilient financial life, make sure you're subscribed to the channel. My goal is to give you the tools to build not just a bigger portfolio, but a more rational mind. Now, I want to hear from you. Drop a comment below. What is the single biggest emotional challenge you face when you're investing? Is it fear of loss? Fear of missing out? Let's start a conversation and help each other build a stronger community of investors. Thanks for your time. Now, go build your plan.